Hello and welcome to the Midday Market Update here at FreightWaves for July 2nd, 2020. My name is Kevin Hill, and as always, I'm joined here with Michael Vincent, and this is our, I believe it's interactive.
It is interactive. Good afternoon, everybody. Welcome to the show. Yeah, this is our twice weekly, Tuesdays and Thursdays, right?
Yeah.
At noon, interactive show. So get your questions and comments in on FreightWaves LinkedIn and Facebook channels, and we'll get them answered. We'll read your comments if they're appropriate for air.
And make sure they are appropriate for air.
We have our highly skilled censor right here, Kevin Hill.
Yes, I'm the moderator today as well.
You are the moderator
double
today.
Double duties here, so hopefully I don't get too confused with all the jam-packed action that we have on
We do have a
show.
great show today, actually.
We do. At the bottom of the hour, we have Sherman Barnes from Trio Enterprises.
Yeah, he's head of sales and marketing at Trio. That's right.
And then we have Thomas Healy, who's the founder and CEO of HighlyOn, which is the renewable natural gas.
Yeah, hybrid truck technology, right?
Yep. Manufacturer. So they just went public last week.
Yeah.
So we'll be talking to him about that. But first, as always, we'll jump into the headlines on FreightWaves.com. And we had a big development yesterday that's spilling in over today with YRC. And I think the federal government now owns 30% through a bailout package. What do we have on that, Andrew Cox?
Yes, Kevin. The claws are out the claws are out already, with some industry onlookers questioning the government's rationale behind making a huge loan to LTL carrier YRC Worldwide. This is a company that perpetually struggles and one that the government's own Defense Department alleges overcharges for its services. On Wednesday, YRC Worldwide announced a $700 million program that will allow it to make delinquent health and welfare, as well as pension payments, and fund capital expenditures for its tractors and its trailers. As part of the deal, YRC will be required to issue the Treasury Department shares of common stock, which YRC expects to equate to, yes, about a 30% equity stake in the company. On Wednesday, in a statement on the lending agreement with YRC, the Treasury Department asserted that the carrier is critical to maintaining national security. The note continued to say that YRC is a leading provider of critical military transportation and other hauling services to the U.S. government and provides 68% of the LTL services to the Department of Defense. This loan will enable YRC to maintain approximately 30,000 trucking jobs and continue to support essential military supply chain operations and transport of industrial, commercial, and retail goods to more than 200,000 corporate customers across North America. But the company's financial weakness caught the notice of Catherine Rampell, a syndicated columnist at the Washington Post, who said in a Wednesday tweet, "The U.S. Treasury is giving a $700 million loan to YRC Worldwide, a troubled trucking company with a market cap of $70 million as of Tuesday's close." In a note to clients, Deutsche Bank analyst Amit Mehrotra said, "On a critical side, the company's current position is not due to the coronavirus. Instead, we see it as a product of a decade of underinvestment, as well as fixed flexibility due to union representation and its workforce. A key concern is whether the financial outlay is warranted for a company who has struggled to stay in business for more than a decade and faces several structural headwinds, high debt, a costly union labor structure, and an aging fleet and technology. That raises questions about whether the loan is indeed a short-term bridge for a company that has incurred financial misfortune due to the pandemic-related shutdowns, and whether it is in fact integral to the nation's security."
YRC. So we have some comments about YRC, of course.
Oh, okay, great.
You know, Robin Anderson, the vice president of sales at Genie International, I believe, a YRC bailout again. And she also says there are plenty of better LTL carriers. James Fucarino from Aerotech Logistics says, almost reminds me of when the feds kept bailing out Pan Am. Remember Pan Am?
Oh, yeah, I remember Pan Am. Yeah,
sure
absolutely. Yeah, I don't necessarily disagree with those things. It's interesting to see what's going to come of this, as they mentioned. They're integral to defense logistics, right? Mm-hmm. And so the government is now bailing out a vendor of theirs.
They are, yes. And that they're also, I believe, suing. at the moment for overcharging them.
And suing them for overcharging at the exact same time. I think their concern is more towards the employees and all the pension funds of the Teamsters that they're supporting as well with these deferred payments. I think,
and there's some private equity money in there as well.
Yeah.
From Apollo, that's about $600 million debt that they restructured or lent out a couple months ago, and they're getting a $700 million lifeline right now. So there's a lot of questions on that. So they'll be in the news for a while, and we'll do follow-up stories here at FreightWaves.com on that. The next one, still in Washington, is the House approves trucking insurance increase and hours of service delay. And that came out of the House yesterday. What do we have on that, Andrew?
Yeah, Kevin, this one's brought to us by John Gallagher out of Washington, a major infrastructure package that includes provisions to hike truckers' insurance coverage to $2 million and delay the September 29th start date for the new federal hours of service. Changes was approved today by the U.S. House of Representatives. The $1.5 trillion Moving Forward Act, which passed the Democrat-controlled House largely along party lines by a vote of 233 to 188, was derided by Republicans in the chamber as a wish list partisan bill heavy on climate change-related proposals that is unlikely to move past the Republican-controlled Senate. It's an absolute failure, and it's not going anywhere, commented House Transportation and Infrastructure Committee Ranking Member Sam Graves out of Missouri. The White House Office of Management and Budget recommended this week that President Trump veto the bill if it were to pass. Independent owner-operators who had initially supported the package retracted that support after what they called was a poison pill amendment was added to the bill, that increasing of the insurance requirements from $750,000 to $2 million. While supporting the legislation's primary goal of working towards the reauthorization of the FAST Act and improving the nation's infrastructure, the ATA also opposed the insurance increase. This language was written by trial lawyers, supported by trial lawyers, and to no surprise, benefits trial lawyers, commented ATA Executive Vice President of Advocacy Bill Sullivan. The legislation does include a 5-year reauthorization of surface transportation programs, including over $3 billion for driver and motor carrier safety oversight by the FMCSA. The legislation funds grants for truck parking, establishes limits on detention times by shippers if drivers are not compensated, restores public availability of driver safety scores compiled through the FMCSA's Compliance, Safety, and Accountability Program, and creates a task force to investigate predatory lease purchase agreements between carriers and independent owner-operators. However, it also requires the FMCSA to conduct a safety review on the effects of the final HOS rule, which would delay the effective date by at least 18 months. Safety advocates and the International Brotherhood of Teamsters have filed a petition on this HOS rule, also seeking a delay.
So what do you think, Michael Vincent?
Well, it's interesting that nobody's in favor. ATA and the independent owner-operators are both against it, and
the hours of service portion, or the insurance, or both?
Both. They're both against the insurance. They're against the insurance portion of it.
Yes.
Primarily. I think the hours of service, we went through those. I thought there was some pretty good flexibility that was being built into the hours of service that was in there. I can't remember the exact details, but I remember it was fairly good stuff, and it was only being delayed by what now is they're also funding an initiative to go into and look at the safety of those new changes before they would go into effect, which then it delays that by 18 months. So I failed to see where an increase in the insurance amount to $2 million improves safety in any way, shape, or form. So I don't really understand why it's in here.
Well, they're both part of a very large spending bill, right?
Mm-hmm. That's right.
With that, there's going to be a lot of horse trading, a lot of wild cards. I think one of the wild cards is where the insurance lobby stands on certainly the hike and also the hours of service as well, because I have the feeling that they have deeper pockets than the trucking lobby. So if the insurance lobby, so that's a wild card out there. What are your thoughts on that, Andrew?
Well, my thoughts are it's a shameless exercise of politics going on right now, in which we have a crumbling infrastructure and we have the FMCSA, which is in need of more money, and yet we have both Senate Republicans and House-controlled Democrats going back and forth, putting in these little poison pills to try to get get forward their agendas. I think it's shameful. It truly sucks for the drivers that this end up does getting passed, because there's a lot of great things for the drivers in this bill. There's billions of dollars to be spent on improving our infrastructure, which is great for the drivers. But I'm with you, Mike. I don't see how increasing this insurance requirement from $750,000 to $2 million improves safety whatsoever.
Yeah, I don't see it. And at first I would have thought that the ATA would kind of prop this up a little bit, or be more proponents of the insurance portion of this, as it does tend to it would weed out some of the competition, I would suppose, right? And with some of those costs, but that does not seem to be the case at all with the comments that Andrew just read from the ATA. They're not in support of it, and it's specifically because of that insurance portion.
I think the insurance lobby probably is, and that's where the real battle probably is.
Of course.
Going back to YRC really quickly here. Jarvis St. Julian, who is the chairman at Global Expedited Logistics, said the YRC offers the best LTL service. Employees have suffered from poor management for years. This is a win for the employees. I will say it is definitely a win for the employees. I think the best LTL service is subjective, and everyone's with their own opinion, right, on that.
I think you're right.
I'm not saying, it's just a very subjective thing.
I get it.
Matt Henning, weird how for years companies in the U.S. said they couldn't compete with China because of government subsidies, ownership, and currency manipulation. Now the U.S. does the same, kind of with a state-owned LTL operator, or partly state-owned, right?
Well, 30% is fairly significant share.
Yeah, very good. Yeah. So, Andrew, we have some other news at FreightWaves.com on the high seas and crew members coming down with COVID-19.
Yeah, Kevin, this one comes from Greg Miller. Shipping groups and seafarer unions are desperately trying to convince governments to allow crew the right to transit after work contracts expire. Most governments still haven't listened. An estimated 200,000 crewmen remain stranded at sea, unable to get back to their homes after the initial work contracts are expired. It will be even harder to convince governments to allow seafarers passage through their ports and airports if more shipboard outbreaks occur. And while they are still relatively rare, new incidents are indeed emerging. In the past 2 weeks, 15 of the 28 crew aboard the tanker Minerva Oceana tested positive, as did 10 of the 23 crew on the container ship Maersk Idaho. The consequences may extend far beyond these two ships and their crews. Future fallout from the crew crisis could affect all shipping segments, from tankers to dry bulk to container shipping to gas transport as well. FreightWaves asked Fabricio Barcelona, Assistant Secretary to the Seafarers section of the International Transport Workers Federation, whether he feared more onboard outbreaks could make it even harder to lift crew travel restrictions. He said, "I'm very much concerned that the recurrent news of a possible second wave of COVID-19 will impact the already strenuous situation of a few 100,000 seafarers still awaiting to be repatriated. If there are not enough crew left on the ships with unexpired work contracts, vessels will be detained for failure to meet minimal manning requirements. Ocean transport would begin grinding to a halt, impairing the economic relief and recovery efforts. I fear that the over-exhausted seafarers, not many ships will be left in position to trade," said Barcelona. "We have tried to alert countries that something needs to be done right now because the situation may deteriorate even further in the coming days."
It would seem to me that this needs to be a pretty good priority. If you got 200,000 seafarers out there that are stranded due to this.
It should be a very much a high priority. And you think about all the blank sailings and the slow sailings and propping up or driving ocean rates up. This should have the action of driving those rates up even further.
Yeah, I mean, just from a humanitarian standpoint of the 200,000 people that are,
I know, right? I mean,
but also in the supply chain, it needs to be a high priority from all perspectives to figure this out, because I don't understand how those contracts work. I can understand after you've been at sea for a number of months or however long their contract happens to be, that the person that is exhausted, there's got to be some type of regulation of how long they can actually work at sea without it becoming a safety issue or just the rights of being able to go home. But if you've got 15 to 28 that have it and they've on a vessel that have passed their contract, less than, by my calculations, less however trustworthy they are, less than half the people are available to be able to work. What the rest of them do, they're not allowed to work. Is that what happens, or I don't understand?
I would think so.
It's confusing.
I don't understand the regulations either, or that work schedule. But let's go from the ocean back to the land and talk about the freight markets today. And joining us right now is here at FreightWaves, Director of Freight Market Intelligence, Zach Strickland. What are the freight markets doing today?
Hey, Kevin. So yeah, the freight markets continue to be pretty active heading into the holiday, as anticipated. Now, it's still quite anomalous to see the continued increase in freight volumes as we get closer and closer to July 4th. Typically, things have already started to moderate at this point in time, but they still have a day-over-day increase, even though it's just slightly at this point, a 0.16% day-over-day increase as we approach the holiday. Again, shippers probably getting a lot of this freight out of their warehouses, et cetera, making some orders for next week. But what is still somewhat surprising is the tender rejection index continues to climb higher and higher with no signs of slowing, even as volumes start to show a little bit of a hesitation going into the holiday period. You and I talked about this on some of the freight forecasting, Mike, where how long is this going to last? It's really hard to tell, but we are getting closer and closer to that point where we were in March, where volumes topped that 13,000 topping point in March, where we had all that panic buying. Tender rejection rates were actually a lot higher at that point in time, around 19.2%. Again, Kevin, you were thinking that maybe we'd hit 20% by the end of the week this week on the tender rejection rate. That does not appear to be the case, but it still looks like it might be in the cards for post-July 4th as capacity continues to show no signs of slowing down in terms of tightening.
Yeah, I think the OTRI, the tender rejections seem to be a result, I would think, of the volumes now are not quite as fragmented as they used to be, right? There's a little bit more normalization of the routes, and carriers are able to get their a little bit more efficient in getting their capacity into the right positioning. When you think, Zach?
Yeah,
compared to March when everything just went crazy, right?
Yeah, I think,
when it was totally fragmented.
Yeah, I think March itself was really just this explosion of freight coming all at once. This has been kind of a slow roll. Coming out of May, we saw a lot of those volumes come off the West Coast.
Yeah.
And then it kind of slowly spread throughout the country. Now, those volumes have now grown throughout the country into a more even distribution, but it's still not showing a real sign of slowing on the West Coast, which to me indicates that we're still seeing a lot of freight coming out of those warehouses in DCs, in that Ontario, Los Angeles market. Which is supplying a lot of these inventory levels across the country. And that's an indication that we might see continued tightness throughout the month of July until that market kind of slows down, because it is so difficult to manage freight networks when you have a large West Coast outbound volume, because you can't get back there very easily. That's a multi-day run going back to the West Coast. And unless there's something returning or going back, which there does not appear to be enough of, to balance out the freight market, you're going to see this continued destabilization in the freight market.
Yeah, I was looking at the tender lead time as well, Zach, and the tender lead time jumped fairly significantly yesterday or today, which would indicate that there's a lot of volume going to be moving post-4th next week.
Yeah, the lead time is a good indicator to watch, especially around the holidays. It's kind of the tipping point when shippers start to push some of that freight into the next week as they're going to take some time off. Friday, obviously, is the holiday celebration period, so a lot of companies have taken that time off. But if we still continue to see an increase in volumes during this period, that's just going to double up as people are not yet ready to come back from, on the road. After taking some time off, especially the drivers as they've gone to home time, et cetera, or wherever they're going at this point in time. And it takes them a minute to get back on the road. So that definitely doubles up that capacity limitation coming out of the holiday, which does look like it's still going to remain tight. And again, the fact that we are at such high levels of volume, it's been proven that the market cannot handle that amount of freight moving in the system at any given time. So it's going to take a minute for it to come back down. even though it may, even if it does fall like it did in March, which I don't think this will be the same type of situation, just, considering the fact that that was a very near-term event and everybody's really just ramping up. So I think we'll see a little bit more of a slower fall after the holiday.
Yeah, I would agree with that. I don't see a steep cliff like we did in March, obviously. That was panic buying, preponomics, whatever you want to call it. But this is a startup. There'll be bumps and highs and lows as we move forward. It's got to come down eventually.
So Zach, how's the produce markets and the reefer markets on the West Coast adding to the tight capacity out in California?
Yeah, it's definitely a thing. Even though the produce season has not been irregular by any means, we've seen steady ramping in volumes, steady flow of freight volume, et cetera, coming out of the West Coast. It hasn't seemed to destabilize the market, but the market was already kind of in flux with a lot of competition for carriers to, pull freight off the West Coast already. It's definitely had an inflationary impact to a lot of freight rates coming out of the West Coast. We continue to see a lot of spot market rate increases, although they're a lot more steady. You're seeing these, minimal, $50, $100, all-in rate increases coming off the West Coast right now every single week, and it's not been slowing down, but it's not a huge spike. Like in 2018, we saw rates jump from $3,000 a load to over $6,000 a load coming back east, and that was, we haven't seen any real surges like that just yet. It seems to be a very consistent climb right now, which makes me think that it's going to be a consistent fall as well.
Thank you very much, Zach. And you and Anthony did Freightonomics yesterday. What was your main topic?
Yeah, we hit on the the sustainability of this freight market that we're operating in right now, as well as we talked about the implications of the insurance and YRC bailout situation. So we kind of hit on both those topics and then dove into the freight volumes, and we discussed some of the headwinds and maybe tailwinds for keeping this freight market active.
Thank you very much, Zach. And you can catch Freightonomics on Freightcast or FreightWaves TV. Freightcast is the podcast version that you can find anywhere, Apple Podcasts, Spotify, wherever you listen to your podcast, or FreightWaves TV for the live or the recorded video version of that.
Right on.
So on the freight market sides, what do you think? What do you think we'll see in July? Do you think Zach is spot on?
Yeah, I'm in agreement with Zach. I mean, at least next week, you're going to see volumes that are going to stay up. I mean, we're seeing that in a TLT. The volumes that you're seeing being tendered today are 2.7 days on average out, right? So that's tendering Monday, et cetera. So next week's going to remain high. I think it slowly comes down. I think by August we see that it has come down.
You know what else bodes well for the freight markets in July are the unemployment numbers, which came out, the monthly unemployment numbers. And Anthony Smith, our lead economist here at FreightWaves, is here right now to discuss that announcement this morning. What were the jobs number or the unemployment claims for the month of June, Anthony?
Yeah, so we just got the monthly unemployment numbers, and it coincidentally fell on Thursday, so that also means that we have jobless claims numbers as well. So the unemployment rate came in at 11.1%. This is down from the 13.3% that was stated last month. Again, that month's report had some discrepancies with some misreporting of some individuals, so this one is also going to be dived in very closely to see if there are any more discrepancies within this report. On the jobless claims front, we saw that jobless claims came in at a 1.43 million claims over the last week. So this is stubbornly high compared to what most analysts and economists were expecting to see. But there is a steady decline on a week-to-week basis over the last few weeks. So I think that roughly 2.1% decline from last month's unemployment numbers makes sense. It's a slight decline. It's not a huge decline, but it kind of coincides somewhat with the slow and steady decline that we've seen, stubbornly slow decline that we've seen in the unemployment numbers thus far on the jobless claims front.
So 1.43. It's still a decline, but it's not a very steep decline, is it, Anthony?
No, so the jobless claims are still very, very slow in their descent of decline. So this is kind of almost teetering out, and there's going to be some resistance, I think, with some of these jobless claims numbers coming in as you start to see more counties, more states kind of slow their reopening or kind of peeling back some of those efforts that were kind of put forward in the first place. So as we see some states or some counties starting to reinstate shutting down bars and restaurants and gyms, things like that, that's going to take away from some of the jobs that were reinstated over the last few weeks. So that's going to be something that's going to be a bit of a headwind for these jobless claims and unemployment in the coming months.
Well, what another positive for the jobless claims going forward, of course, is the PMI, which I think came out, was it yesterday that the PMI came out, and it looks like we're in expansionary mode again. Can you give us some highlights on those numbers?
Definitely. So you just stated it correctly. We just got the PMI numbers yesterday, and we've dived into some of these numbers so far, but on an overall arching view, we see that the PMI came in at 52.6, so this is a 9.5 percentage point increase from last month. So we're back in that expansionary period, which is very good for flatbed trailer types. We're looking at potential production on the manufacturing front. We're looking at industrial segments ramping back up. A forward-looking indicator, a component for the index, shows that the new orders measure has increased to 56.4 from last month's 31.8. That's a 24.6 percentage point increase from on a month-to-month basis. So very substantial rise. We're looking at new orders. And on the employment side, we did see a 10-point increase. So it went from 42.1 from a 32.1. So it's still below that 50 threshold that is indicative of expansion. And we are starting to see a little bit more rise in inventory levels. So overall, there was a positive report. This industry index is very indicative of, again, the manufacturing and industrial segment, and it's not very biased towards one in particular. In fact, it measures 18 independent industries, where it shows that 13 out of the 18 actually saw some growth over this last month.
So on the new orders and backlog orders, how should us amateur economic economists, right? How should we read that? What importance should we put on new orders versus backlog?
Definitely. So when we're looking at new orders, this is very important for kind of like the engine of manufacturing, an engine of production. These are orders that are set to go into production, and so it's going to be indicative of activity downstream, whether that be 30 to 90 days from now, depending on what segment and what kind of orders are being put in. And so when we're looking at new orders, it's very promising right now to see that in expansionary mode. To have that there, I think, is kind of indicative of some kind of growth in the coming weeks, but backlog of orders usually pile up when manufacturers are overburdened with a lot of orders, so things get put on backlog. And when orders start to come down and production starts to come down, they can work through that backlog, so they can kind of get through some of those orders that were kind of placed on hold. And right now what we're seeing is backlog orders are still in contraction, just at 45.3, so close to that 50 threshold. But there is a lot of optimism, I think, going into some of manufacturing. Again, this was one of the two industries that we really expected to kind of come back online first, between manufacturing and construction. But there are, of course, headwinds, as we start to see, just like jobless claims. This can start to impact manufacturing as well and have some supply chain disruptions if more states or more counties start to slow down or implement more rollbacks. So this is something that could really kind of hamper manufacturing production in the coming weeks if we start to see some of those industrial heavy states kind of get impacted with some more social distancing implications on a state-by-state basis.
Thank you very much, Anthony.
Thank you, Anthony.
Phenomenal insights, as always, from our lead economist, Anthony Smith. Thank you for your time today, and have a great 4th of July, Anthony. So the economy is improving, freight's improving. This is good momentum.
We were watching the volumes move through sonar, right? So we're watching all those volumes move in the different commodities, the imports, et cetera, and we were expecting these numbers to be higher there, right? The question is, okay, the pump has been primed, right? And it's moving. You're seeing some new orders, et cetera. It's an expansionary mode, but it's expansionary mode from awful.
From awful, yes,
awful, right? So it is good news. But will the spark still be there?
Let's find out what the market conditions are from someone in the trenches.
Yeah, let's do
that. Sherman Barnes is joining us via Skype. He's the head of sales and marketing at Trio Trucking. How are you doing today, Sherman?
Doing well. Thanks for having me on.
Thank you for joining us. Can you give our listeners and viewers a bit of a background on Sherman Barnes and Trio's Trucking and Enterprises?
Absolutely. So I've been in the business for about 16 years. I've dealt in various modes of transportation, from full truckload, flatbed, intermodal, even to air and ocean. So I've worked at a lot of Fortune 500 transportation providers, UPS, Schneider, C.H. Robinson. And I am with Trio Trucking right now as head of sales and marketing. As you mentioned, we're actually a intermodal company, as well as a truckload company, an asset-based truckload company providing services for various Fortune 100 clientele. And we also provide some consultative or supply chain services from a minority business perspective.
Excellent, Sherman. Thanks for coming on. This is Mike Vincent. I've known Sherman. We're not like really close or anything, but I've known Sherman for a couple of years. We first met via phone when we were first talking about freight futures, et cetera, and we'll get to that in a minute because you have some views on freight futures. But so tell us, how is Trio really weathered the storm of COVID? How was it for you guys going through the heat of the battle there in March and then the downturn?
Yeah, so for us, we've been very lucky. One of our largest customers is P&G, and as you know, toiletries, paper towels, things of that nature. They were really robust during that COVID-19, the epicenter of it, right? When it was really hot and heated. So we actually grew as a company, and we also work with some other companies that actually create products or whatnot that were being utilized then. So it wasn't like we were in an industry segment that was struggling or whatnot. So we've actually grown during that time. And heading into Q3 and Q4, just to continue to talk about that, we're still seeing upticks in volume. We have an expectation that we're going to continue to grow. I was really excited I know that the jobs numbers came out, and looking at those things, you got to buy and sell side of it. So some people think that the market's going to grow, some think that it's not. But we're really excited by the numbers that we're seeing so far.
How's the intermodal market been during the crisis, and what's your outlook going forward through the rest of the year for intermodal specifically?
I think intermodal is gonna grow. So I won't mention names, but I have friends, at the major railroads as well as at other companies, and everybody's unstacking boxes in preparation for a robust Q3 from what I'm hearing. They may not necessarily say that, but it's a lot of different companies that are unstacking boxes, which lets me know the expectation for Q3 and Q4 is growth.
That's excellent to hear. That's really good to hear. So one of the conversations that you and I were having, Sherman, was it comes really recently into light when we were talking with Daniel Stanton last week, Mr. Supply Chain. Yes, Mr. Supply Chain. And we were talking about this, at least there was talk of micro bids or mini bids where shippers were going out to trucking companies and their contracted carriers trying to lock in these kind of lower rates. And is that a good thing? Is that a bad thing? Moving forward, when continued contraction like we're seeing rejections up in the 16%. They're starting to keep tracking, and volumes are going. And as you're saying, there's definitely at least anecdotal evidence of people being pretty bullish on Q3, Q4 on the intermodal side as well. So, but the idea came down to, why aren't you using really indexing your contracts versus freight futures and hedging both sides? What's your thoughts on that, Sherman?
I think that freight futures, I've always been a big fan. So, again, I worked as a freight forwarder before on the ocean side, so it's a little bit more common there. And also some of the materials that we shipped, I was in Wisconsin for a while as well, so the hedging side of it is important. I think it's something that is going to continue to grow in the business. As I've talked about before, just think about how many times has a carrier provided pricing to a customer that's supposedly, for a year, and then the customer starts to tender freight, and, well, I'm sorry, I can't take it at that price anymore. I need to have a price increase. And vice versa is true. as a shipper, as a carrier, there have been times where I've won, in theory, congratulations, you won an RFP, you're in the top tier or secondary or tertiary side of winning some business, and then I don't see any business. And so my salesmen are having to call the customers and see what happened. And in some cases, we never get the business. So I think that the futures market will help, as a hedge or whatnot, to help deal with some of those issues that I see in the market. So I think that even though it hasn't grown as fast as I would have liked to have seen it grow, I think in the future it will continue to grow as a hedge and allow for a little bit more stability in the market that we're in.
Yeah, I think so. I would agree with that. I think it helps solve that issue of the contracted rate, and then when spot rates fluctuate, volume comes, volume go. Oh, I don't have any freight for you. On both sides of it's played by both sides, right? When it comes down to it, it's just they're, as we've called them before, paper rates, right? They're contracted rates. If they happen to give you volume, then they might pay this amount. But if you were tied to something that was fair, like a daily settled price on those lanes marked against whatever basket it might be that's appropriate for that business, that correlates the best. Now it really it kills that incentive. It de-incentivizes that game because everybody knows where it's at. It's tagged to an index, which makes sense. I don't know what your feelings are on that, Kevin, but I see you nodding your head. So
well, it makes sense, of course.
It really does.
What most other markets do, they're tied to an index. You have a whole swap market that is set up that way based on futures, and you can get really exotic on what you do with it. So it's much better than going out and doing mini bids all the time. For that,
yeah, excellent. So Sherman, Trio is the designation MBE. Is that correct?
Yeah, we're a minority. We're a minority business enterprise.
Right.
We're certified 100%. Yep. It's 100% owned by African American gentlemen. Yes, sir.
Yeah. So as we were discussing the talk today, it was wanted to get your perspective from both sides, right? So what is it you should be looking for in a minority supplier, an MBE enterprise supplier, and really from the other side, when Trio is then contracted by those, what are they really expecting from you? What are they wanting from you? So really, your perspective from both sides would be great.
Okay, well, from our side, so I always like to put myself in the shoes of the person that's buying the service or product. So if I'm, a shipper or whatnot, I mean, some of the things that you need to think about is how long has that person, been the minority supplier been in business, right? So we've been in business, as an example, for 40 years. Is the person, are they financially stable company? That's something else I would think about when I'm dealing with a smaller minority supplier. So, for example, we're a debt-free company. Do they have technological capabilities or whatnot to integrate within your systems, whether it's EDI or APIs or whatnot? Like, do they check those boxes? So those are some of the things you want to think about. What benefit would you get specifically from working with that particular minority supplier? Because each one would have, benefits. What a minority company would be looking for from a company, from a larger company, is we're looking for someone who is committed to the community, to serving in the community or whatnot. I mean, so think about your customers. What would your customers think about you working with a minority supplier? Like, your customer base is pretty diverse, and so this would show a level of commitment to dealing with, a subset of the market. Another thing to think about is there are some things such as payment terms, right? So some guys, we're able to do it, but not every minority supplier may be able to pay in, accept 90-day payment terms or 120-day payment terms. So those are some things that a supplier may want to think about as they're going out to reach out to minority suppliers as well. Also, I don't think, some of the terminology in terms of we want a hand up, not a handout, right? So we need to be able to execute, and that's something that we definitely can do. And we've won countless, Carrier of the Year awards, Minority Supplier of the Year awards. So we're good at executing what we do. It's not an expectation that service levels will go down or we're looking for a handout, but we just want an opportunity to add value to a large organization.
That's great insights on that. I have a question. It just passed through the House of Representatives today. We have it on FreightWaves.com, and it affects trucking companies dearly, especially small businesses, since that's an insurance hike. Insurance hike up to $2 million in coverage. What do you think that's going to do for the small to mid-sized fleets out there?
I'll just say it. That's not good. As you guys know, there's a certain amount of cost to run a truck. To just even break even, which is already been challenging in an environment like this, right? So now the insurance going up even higher. That's going to really hurt some people. So like I said, we'll be fine. We're large enough. We're a $60-something million company, but some guys that may be 10 million or 15 million. The average size of a small trucking fleet or whatnot is pretty small. So for me talking to some other carriers, I just don't know if they're going to be able to make it. So it's very unfortunate and disappointing.
I agree.
It isn't done yet.
And no, it says it's far from done. So we'll see.
It's past the house.
But we'll definitely be following
it's past the house. So
Yeah, it wasn't killed. So you're right. I agree with you. Yeah, it's not good news.
The probabilities just keep on climbing, even though they might still be low, but they're climbing. Well, thank you very much, Sherman, for joining us today, and have a happy and safe 4th of July.
Absolutely. You too. Now, take care. Thanks again for having me.
Thanks, Sherman.
Thank you. And you can find Sherman Barnes on LinkedIn, Sherman Barnes II, on that. But we're ready for our next guest now.
Good insights.
It is. It's really good insights, certainly. So joining us now is Thomas Healy, the CEO of HighlyOn. How are you doing today, Thomas?
I'm doing great, guys. Thanks for having me on today.
Well, thanks for joining us. And can you tell our audience a little bit about HighlyOn and yourself?
Yeah, absolutely. So HighlyOn is bringing electrified powertrain solutions to the commercial vehicle industry, specifically focused on the Class 8 market. And we have a couple of products that we're bringing to market. One is a hybrid electric solution. Our second product is a full electric drivetrain solution that's able to be fit on brand new vehicles that are coming down the factory lines. And so really, being on the forefront here of bringing electrified solutions to the Class 8 market.
So on the electrified market, what do you think are the biggest trends are, or the biggest, the biggest trends are right now?
Yeah, I think, honestly, we're at a point today where I think fleets know and realize that electrification is coming, right? And I think, a couple of years ago, fleets were looking at it and trying to figure out, is the industry going to shift to electric, or are we going to stick with, the present solutions today? There's been so much buzz around different electrified solutions and new products coming to market that, what we've heard from fleets is that they want electrified solutions, that they really do see this as the next evolution here in the commercial vehicle space. And from our end, as mentioned, we're really focused on the Class 8 space, but specifically the long haul, over the road, as well as regional type applications. And when you look at an electrified powertrain, not all solutions are the same, right? If you've got a battery electric vehicle plug-in off the grid, that's a great solution for kind of local delivery, short haul, final mile type applications. But when you really start looking at that long haul application where drivers are going 500 miles a day, either you need to have a really large battery pack in order to be able to drive for the full day, or you need to actually bring the generator with you that produces the electricity. And that's the approach that HighlyOn is taking. We're actually leveraging a natural gas generator that's on board the vehicle that can actually charge the batteries up as you're driving down the road.
Okay.
That's interesting, because I was going to ask how that actually that hybridization actually works. So, how available is the renewable natural gas on for your systems?
Yeah, so RNG, it's another mega trend that's going on where RNG is basically a form of natural gas, right? So similar to the electric grid, you have some electricity that comes from wind and solar, you have some that comes from nuclear and coal, right? Renewable natural gas is a form of conventional natural gas, and it's widely available. Actually, out in California, I think it's over 70 or 80% of the natural gas used in vehicles is actually coming from RNG. Nationwide, I think it's about 40%. So it's a pretty significant amount of the natural gas available is renewable, and it's growing every year.
So RNG and having the generators in the truck, is that a method for kind of bypassing the infrastructure issues with filling stations, natural gas stations, or charging stations?
It exactly is. I mean, when we looked at this problem and, how do you bring an electrified powertrain to the Class 8 space, there are really three things that really factor into the equation here. The first is the cost of operation, right? As you guys know better than I do, I mean, the industry operates on very slim margins, so we need to bring solutions that are actually going to be able to reduce operating costs. The second is the emission side of things, and that's one of the big benefits that Orion G has, is it actually is a net carbon negative, so a below zero emission profile. And then the last one, as you just expressed, this infrastructure for natural gas is already out there, right? There's over 700 stations already built out across the country. Now, they were initially built out for conventional natural gas vehicles, and when those vehicles were initially introduced to the market, I think there were some issues and hesitancies from fleets. There were some maintenance issues, which have since been rectified and resolved. But there's also an issue of conventional natural gas vehicles are just underpowered, right? And so what we're able to do is we're saying, hey, let's take all the benefits of natural gas, which is low cost, low emissions, and couple that with an electric drivetrain, which has way more horsepower and torque than even a conventional diesel. Couple those together, you get all the benefits of both of them, and you already have an infrastructure that's already built out across the U.S.
That's really interesting, because I was going to ask you, why hasn't natural gas really caught on in a much bigger way in trucking? Because the solution you're talking about sounds awesome. Is it because they weren't coupling it with the electric drivetrain? Is that what it was?
Yeah, so the conventional natural gas truck, it's like a diesel. You've got your engine, transmission, and then drive shaft, right? So the CNG engines that are out there today, we actually put one on a dyno, and it only put down about 260 horsepower at the rear wheels, right? And so that's kind of the pain point of natural gas vehicles today, is just the lack of power. We actually had a truck driver come by our facility a couple of days ago, and he just wanted to check out what we were doing. And he said, my perception in natural gas is just underpowered trucks, right? But he hopped in our hyper truck, and he was like, man, this thing's got more horsepower than my diesel truck does. Like, this thing, puts you back in your seat, right? Yeah. And that's the benefit of electric powertrains.
How do
instant torque.
It is, yeah. Yeah. How do incentives differ and compare between your hybrid technology and traditional kind of battery-powered vehicles and technologies?
Yeah, so there are definitely incentives out there, and there are even actually incentives for natural gas that we fit into as well.
Yes.
And I think one of the key things to mention with the solution, because there's kind of a question out there of, well, are municipalities or are ports going to move to totally zero emission zones? And with our solution, we have actually the capability of, when the truck's driving in, to, let's say, the port of LA, right? You can actually turn the generator off as you're approaching the port, run on purely battery power, go into the port, pick up your cargo, make deliveries, right? And then come back out. And when you leave, then that generator can kick back on and start charging up the batteries. So we actually offer the zero emission capability, because you can turn that generator off when you want to run on purely battery electric.
That's really interesting. Yeah. So, Thomas, some see the hybridization model as it's a stepping stone, or it's going to transition you to fully electric vehicles. What do you have to say to that?
Yeah, I think that kind of talks to our two products, right? So our first one that we're shipping to fleets today is purely a hybrid product. It's like a large Toyota Prius. It bolts on, to your existing diesel powertrain, and the goal of it's to save you money and save you diesel fuel and reduce emissions, but it's not replacing the full powertrain. The Hypertruck powertrain, that's the natural gas, recharged off of a generator solution, that is a pure battery electric vehicle. It's the same vehicle architecture as a fuel cell truck. The only difference is, as opposed to using hydrogen in a fuel cell, we're using natural gas in a generator to recharge the batteries. So when you look at that Hypertruck solution, that really is a full electric vehicle. The vehicle is driven purely off of an electric motor.
You had some exciting news. Was it last week, I believe? HighlyOn's now a public company. How long was that in the works for, and what was your perception of the process, and how does it feel now?
Yeah, so it's exciting. It's extremely exciting. So about a week and a half ago or so, we announced that we were doing a merger with Tortoise Acquisition Corp. Tortoise is a publicly traded company on the New York Stock Exchange, and it's a SPAC transaction. So what that means is, we're now going through an SEC review period right now, but we're looking to actually close the transaction in a few months here. And when that happens, then HighlyOn will become the publicly traded company when the deal closes. And so, right now, the public company is Tortoise, which is under the New York Stock Exchange ticker SHLL, and then that will become HighlyOn in the future here. For us, it's extremely exciting. It's we've went out and raised both capital that's coming in through that SPAC transaction, as well as there's a process called raising a pipe along with it as well. So in combination, we're bringing in up to $560 million into the organization to continue to grow what we're doing, and that's really the capital that we needed in order to really take our solutions and bring them into commercialization, move them into volume manufacturing. We can talk a little bit more about that if interest, but we're actually leveraging one of our partners who we've been working with for a while, Dana. We're working with them on the actual manufacturing of the solution, and the goal is to really move this into a volume product that fleets across the country and globally are beginning to adopt.
Excellent, excellent. So, Thomas, two things. One, excellent decision not to change HighlyOn to Tortoise Trucks. Nothing against them, but I'm voting for HighlyOn instead of the Tortoise Truck.
Yes, I agree. I concur.
I think Kevin agrees. So, ESPN.
You know who wins.
Yeah. That's a solid point. But as if I was one of your sales reps, I don't want to have to explain that. So, but so the ESPN, what was it? Last Dance or whatever with Michael Jordan,
yeah,
et cetera?
The Last Dance.
The Last Dance. So, they talked about Michael Jordan really, he would fuel himself with some sort of anger or hate or whatever it was to drive himself forward, right?
Chip on his shoulder.
He would put a chip on his shoulder. He would even make things up, right? So, Nicola and others' dismissive comments about your hybrid technology at all, is that your chip on your shoulder? Does that drive you, or you just kind of doesn't matter, I'm moving forward anyway? What's your chip on your shoulder, man?
No, honestly, it's more the latter. I mean, we take the approach of all boats rise with the tide, right? And so we see it as though the more that's going towards electrification, the better off we'll be, the better off our competitors will be, because ultimately the goal is let's get electrified solutions into the hands of fleets. It's gonna revolutionize the industry, frankly, right? I mean, it's going to. We lost.
Lost the lights.
We lost lights. Give me 1 second.
Okay. There we go.
You had to turn on it. You had to turn on your Orion G generator to.
That's the problem with having the energy efficient buildings. When they don't think someone's in the room, the lights shut off.
Yeah, I get it. That was awesome.
I mean, we're viewing it as like, let's get more electrified solutions out there, and I think fleets are super receptive to what we're doing, what Nikola's doing, what Tesla's doing, and ultimately they're trying to figure out what's going to be the right solution for them. There are applications where, as I mentioned before, going purely BEV plug-in off the grid, that's going to be best for some fleets. There are other solutions that, hydrogen fuel cell are going to make sense. We just view it as, there's a lot of benefits that come from natural gas, and using that coupled with an electric powertrain, it really comes down to the three things. It's, we're able to offer that lowest total cost of ownership, which is crucial to fleets. That net carbon negative emissions is very attractive, right? A lot of corporations are coming out with zero emission climate plans that they want to achieve in years ahead. Well, we can actually give them a negative number, and then that can offset some of their manufacturing emissions, right? And then the last is just being able to tap into that already built out infrastructure. It allows us to just deploy vehicles much quicker because we don't have to worry about where the truck's going to get refueled. The stations are already out there.
It's excellent.
That is excellent. Now, you're going to be on The Truck with Dooner and
myself,
dude, Michael Vincent, on Monday, correct? So So Monday at
No, we're
noon.
looking forward-
So
Yeah.
just get somebody, your admin assistant or something, to stand near that sensor and just wave their hands.
Just keep on just waving your hand.
Just keep waving your hand.
Thank you for your time today, Thomas. And for everyone who wants to learn more about HighlyOn, where do they go?
HighlyOn.com. We've got a lot more information about both of our products. And, there's a lot of exciting things happening, and appreciate you guys having us on the show here. And, look forward to getting the opportunity to chat more with you guys as we continue down this journey. It's definitely going to be exciting.
It will be
Excellent.
exciting and our pleasure having you on anytime.
Yeah, absolutely. Thank you, Thomas.
All right. Thank you.
You can also catch the Q&A interview on FreightWaves.com. Alan Adler,
Yeah,
who
that's right.
published that late last week. So
It's really interesting stuff, right?
is.
Back in my day in LTL, we were testing natural gas.
Mm-hmm.
I mean, and we're going back 30 years, right?
Yeah, and we have
they
some
were
fueling
dogs, man,
stations.
because
we
they were
have
combustion engines trying to burn natural gas as the
Yeah. And we
combustion.
have a lot of stations in Oklahoma, of course. We're
Oh, yeah,
a lot of
of
shell
course.
and fracking and infrastructure in place that just hasn't really caught on too much. But let's get to some good news. We're running out of time.
Okay.
Today, so let's jump right in.
Are you trying to nudge me along here? Is that what
just
that is?
nudge you along? Yeah.
You got it. So in What's Good, Love's, which was one of the first companies in the supply chain to give its employees what amounted to battle pay in the first days of the pandemic, is extending it another month. The spokeswoman confirmed social media posts that said Love's will give its full-time employees who work 120 hours in July a $300 bonus. Part-timers with 80 hours during the month will receive a $150 bonus. The date for making those milestones runs through July 28th. Additionally, Love's will continue its practice of paying sick pay to employees who are impacted by COVID-19. The pay covers 14 days and runs through July 31st. Our employees have shown true dedication to getting our customers back on the road quickly and safely during the pandemic, and we want to reward their hard work, was the quote there, which is
That's
excellent.
right. No,
So
that is
really good
excellent.
news.
Really good
Absolutely
news.
good stuff.
Good to see that love. So those frontline workers are seeing a
Yeah, we see that
Any bump in pay.
from quite a few, but it's really great to see. But I can't wait till we don't need that.
I know, right?
that'll be kind of nice.
And on the insurance, Sergio
Oh, yeah.
Martinez, who's the owner op at Midnight Hustle, says just park the trucks and let the economy go bust, and they will change their mind about the insurance quickly when it comes to high insurance requirements. On the other hand, yes, insurance companies have more than as just cause than all that may steal from them. All
Okay.
the money. You know what? When I actually have to do this, I'll think then I should wear my glasses because I can barely see anything.
No, you can't borrow mine.
I can't.
You'd have to spray them down.
I
have
know.
to spray them down.
So later on today, 4 p.m.
Yeah,
freight
4 p.m. freight forecasting.
What are you doing on freight forecasting?
So I'm going to have Zach on, and we have been talking about the volumes, et cetera, and what we see after the 4th and what's going on, and looking at all the economic numbers. But today we're going to take a step back a little bit. Right. So, what we're talking about today on freight forecasting with Zach is really that first thing in the morning. You've got Sonar. What are the tools? What are the data sets inside it that can help you prioritize your day, understand what the markets, the lanes are, prioritize assisting customers where to get freight from all three perspectives, really: the carrier, the shipper, and the broker. So it's kind of a step back. Okay, how do I start my day and instantly be able to be effective and get the ball rolling first thing?
Right, great. And in case you missed it, that's at 4 p.m.
That's
in
at 4
case you
p.m.
missed it, we had Wednesday, we had Put That Coffee Down with Tuna and myself, where we talked about bad job postings and bad jobs and how to identify red flags in that. Anthony and Zach on Freightonomics talked about YRC and a few other things in the economic news. And then Tuesday, Great Quarter Guys, they talked about 3PL earnings. And Monday on What the Truck, you guys talked about everything you guys talk about on What the Truck. And you can find all of this on FreightWaves TV.
You can go to tv.freightwaves.com
TV.freightwaves
and sign
or
up.
Freightcast. Anywhere where you can download podcasts, you can get the audio versions. But that wraps it up for this. Hopefully, everyone has a safe and happy 4th of July.
That's right.
We'll catch you Tuesday for our next edition of Midday Market Update.
You got it. Peace and love. Have a great 4th, everyone.